Well, good afternoon, everyone. I hope you can all see me and hear me nice and clearly. I can see we've still got a few more people joining in, so I might give it a few seconds. But just as introductions, for those of you who haven't joined before, my name's Tommy. I sit alongside Mel on the investment team, and we'll be hosting this webinar today. I think we've probably got most people now. So, in the interest of time, I'll get started. For those of you who are new to join, the Carrington Markets Insight is a quarterly webinar we do, giving our thoughts on the quarter we've just had, reflecting on some key topics and also our portfolios. And then we also tend to talk about some different themes that are going on at the moment in markets and how those are playing how we're playing them within our portfolios. So for today's webinar, we'll do a quick recap of the quarter just gone. We'll have a discussion on interest rates and what the outlook is, which has been a sort of ongoing theme now for quite a while, but is still very prevalent today. We're also going to review artificial intelligence. This is a topic that has come up a lot, especially in this year. We've seen really sort of fast developments, and so Mo's can give you guys a bit of insight into that. And then we'll sort of summarize all of that with a look at our strategy moving forward, and then a brief summary at the end. And as always, right at the end of the webinar, we'll have the time for Q&A where you can ask any questions you may have. And those of you who haven't joined the webinar before, the Q&A function is usually a little button at the top or the bottom of your screen, which you can enter any questions in and ask us. So with that, I'll pass you guys over to Mo.
Good afternoon, everyone. Thank you very much for taking the time to join us today. So we just get straight into it. It's actually quite a long pack today, so we'll try and crack on as quickly as we can. So, apologies, I'm just going to move something around. Got something obscuring my view here. So yeah, just to quickly recap Q3, as Tommy mentioned, the key point being over the quarter was renewed talk of higher interest rates. And that was across the board from the US Federal Reserve, the European Central Bank, and the Bank of England. So that did lead to some degree of volatility, but generally speaking, it was quite a smooth quarter. There were renewed Chinese growth concerns, which has been rolling on for a few quarters now. And in addition to that, there were sort of US and China tensions, again, ongoing, but more recently, these seem to have focused more around semiconductors, and I believe only last week, the Chinese were talking about perhaps restricting the supply of the raw materials that are required for semiconductor manufacturing. So again, that's ongoing. Lots of political sort of brinkmanship there, and ultimately, I think semiconductors are vital to both of their economies and the global economy, and so it's sort of unlikely really that we're going to see any sort of material degradation in the manufacturing of semiconductors. Also, thankfully, no record-breaking market movements. I know it has become a quarterly habit of reporting some sort of precedent that's occurred. Thankfully, nothing over this quarter. And in terms of portfolios, generally speaking, the portfolios delivered small positive returns. It was sort of tricky though, and we'll come on to that now. If I can move the slides along. Okay. So it was a very mixed quarter following the collapse of Silicon Valley Bank and Credit Suisse in Q1. Some of the equity markets were positive, mainly the US ones, and we'll come on to why a bit later on, but that was largely due to technology stocks, and particularly those attached to artificial intelligence, seeing some significant share price gains. The bond markets were generally flat to negative. Gold was also down, and then some currency effects didn't particularly help. So much of the quarter was spent. We saw the pound appreciating against the dollar. Now, for all of our overseas holdings that are denominated in dollars. Clearly that's a headwind. And so that didn't help also. So as a result, that led to, generally speaking, small positive gains where our global and US orientated holdings were positive. Mainly our sort of UK and Asian holdings were flat to negative. And as I mentioned, the bonds and gold, etc., were also had a bit of a tough time. Dominant theme, as I mentioned, was talk of higher interest rates. That's sort of back on the agenda. There was lots of hype around the artificial intelligence, and we've decided that this time we're going to spend a bit of time on this later in the pack. As I mentioned, weakening Chinese economic data, and that's largely due to two reasons. Domestically, they haven't quite seen the economic rebound that people were expecting as they've eased COVID restrictions. And secondly, the rest of the world is generally slowing down, particularly from a manufacturing perspective. And so that's hitting Chinese sort of the export market over there. There's been a mixture of US economic data. Some of the more manufacturing orientated data has been generally sort of quite weak. However, the labor market, so employment, etc., remains relatively strong. And given that that makes up a large proportion of the US economy, the US has so far weathered the environment relatively well, despite lots of predictions for other outcomes. Yeah, so as I mentioned, the US in particular did well this quarter, and pretty much everywhere else was either flat or negative. But thankfully, because we do have a good allocation across most portfolios to the US markets, that resulted in the majority in delivering positive returns. So again, just on interest rates, key topic at the moment is that, let's start with the US. The positive is that inflation is coming down. That's both at the headline level and at the core level. So the core is the one that's more important. It's what the US Federal Reserve focus on. Both of those numbers are now coming down, have been for a while. And that prompted the US Federal Reserve to finally pause in their interest rate hiking cycle. So we've had 9 consecutive hikes, one of the fastest and largest hiking cycles ever. They decided to pause in June. However, they did signal that they were looking at doing maybe 2 more interest rate hikes. So one this month and then one perhaps later down the line in September. So that has got the markets, on the back foot, because clearly, a even more interest rates is generally perceived as an unhelpful environment. Europe, similar, inflation is also falling, but the European Central Bank haven't quite raised interest rates in the same way that the US Federal Reserve have, and so there's a bit of catch up to do. The UK, unfortunately, is in a uniquely bad position. Our inflation remains high. It's struggling to come down. The Bank of England are clearly in a very difficult position, and the rhetoric we're hearing from them and from economists is that interest rates are almost certainly going to go higher. Clearly, no one knows where, but predictions are for somewhere between 6.5% to 7%, which obviously is we're not used to seeing. We haven't seen for quite a long period of time. Asia, on the other hand, is seeing low levels of inflation, particularly China, which is almost back to sort of year-on-year inflation at 0. Their interest rates are up about 3.5%. So they have room to ease policy, and it's widely expected that given the economic data that we're seeing from China, which is generally being quite weak, that they are going to continue to stimulate their own economy. And they've done a bit of it, but we're expecting them to do more in the short term. So that might actually be a positive for them in the region. And so as a result, as you can probably tell, there's been, quite a mixture of backgrounds and outcomes. And so that led to a very sort of mixed set of performance stats over the quarter. If we come on to artificial intelligence, clearly there's a lot of talk around this sort of hype. I've mentioned three things here: ChatGPT, semiconductors, and NVIDIA. We just quickly start with ChatGPT, and essentially it's a tool was developed at the end of last year that uses artificial intelligence to formulate responses to questions. It's a tool that anyone can access online. It's free, and that led to a fair bit of speculation about the prospects for artificial intelligence moving forwards, because the reality is that ChatGPT is a bit of a game changer in what it can do. The adoption rate of ChatGPT in terms of the number of users was, broke lots of records. I've got a little chart here to show this. So this chart shows how long it took for 100 million users for each of those things listed. So, for example, the TV back in many decades ago, smartphones. As you can see, ChatGPT was just 2 months. So 2 months it took for 100 million users to use ChatGPT. So, incredible adoption. And really it's because of the excitement around it, I think, and what it's capable of doing. Before I touch on the short-term effects, just maybe quickly mentioning that in March of this year, ChatGPT released version 4. That was a significant improvement on the version released at the end of last year. And I believe ChatGPT 4 did the bar exam in the legal sector and came in the top decile of performance results. So, it's coming a long way very quickly. It can also now assess images, and I believe the next iteration will be able to decipher videos. So clearly lots of development, and as a result, there are lots of other technology companies such as Google that have their own versions. Some of the Chinese tech companies are coming out with their own versions, and so there is a little bit of an arms race developing here in who can develop the best bit of AI software, if you like. In terms of the short term, there are potential, because obviously the big question is, is this going to, is this technology going to replace humans in the workplace? So in the short term, yes, there's potential for some marginal job losses, particularly within the journalism sector, where ChatGPT can quite comfortably construct an article that can be almost as good as any other human. Clearly, all the information is sourced online, and there are a few others at the margins. However, as is often the case, the markets tend to overestimate the capabilities in the short term and tend to underestimate over the long term. So by overestimating, what I mean is that if we take NVIDIA, for example, NVIDIA make the processing units that are most used in the AI world at the moment. So they've got the leading market position. As a result of their position, their share price went up about 200% in a very short space of time. So that's a substantial move for such a big company. However, that's quite normal to see in markets, and the likelihood is that NVIDIA's share price and others have probably gone too far too quickly. And now what we're going to see is a period of time where these tools are developed, they're enhanced, others will come about, and this would be, years. This would take several years before anything meaningful comes to the market. So that's why, our expectation is that we've sort of seen the short-term bump, and I think things will calm down a little bit from here before we start thinking about the medium to long term. We have seen some corporate adoption, so particularly in the law, gaming, and insurance sectors, as well as others. So within law, I believe they're using artificial intelligence. I think it is ChatGPT to develop first drafts of legal documents. In the gaming industry, they're using it to develop coding or to program software. And there are sort of other use cases at the moment. So there is adoption going on, but it's not very broad-based yet, and it's not sort of deeply penetrating any sector at the moment. The medium term, as I mentioned, is that, further development of the AI models and further adoption, and we believe this is going to be a relatively slow process, as particularly due to regulation as well, actually. So there's been lots of, scaremongering going on about the potential impact to workers. The Italian government briefly blocked or banned ChatGPT in the country. There's lots of other regulations coming through, and I believe the Europeans are about to launch their, I believe they've called it the AI Act, which is coming out soon, to try and set guardrails, as they've called it, around the use cases for this bit of AI software. So, I think it's going to be channeled a little bit more from at the government level, and that therefore might sort of delay the sort of full effect of what AI will eventually be able to do. However, over the long term, we do believe that there's going to be material change in the labour markets and the potential for significant improvements in corporate productivity. So, this is obviously not the first revolutionary bit of technology to come through. We've had many, many cases of this over the past few centuries, pre and post industrial revolution. And in all cases, there was improvements in productivity, and what that enabled was for workers to then focus on other things, or corporations to build out new departments that they perhaps were not able to do previously due to cost restrictions. So, again, if we look at unemployment levels as an example, over the last sort of 250 years, the average unemployment rate across the developed world has been about 5%. And today it is also around about 5%. So all of those innovations that have come through have not led to an increase in unemployment rates. It led to actually improvement in productivity and the creation of new industries. So yes, you could say that, the jobs that are around perhaps 200 years ago don't exist anymore. But then again, today, we have cloud computing engineers, we have social media strategists, and all these sorts of things. So no doubt, new industries will come about, and there'll be new employment opportunities for people. But the labour market will probably look quite different to what it does at the moment. Just moving on to strategy. So this is sort of, fairly similar to what we've said in the past. We are remaining invested, but have opted for a lower volatility approach because due to the higher interest rate environment and the likelihood for interest rates to keep going up, conditions are likely to remain restrictive. That usually can create volatility in markets. We actually did see a bout of that last week. And so we have opted to have a slightly lower volatility approach. We spoke about protective ideas at the last quarterly webinar. And all of you would have had some sort of communication around that those have now been implemented. As a reminder, there are sort of several strategies depending on what model you're invested in, but generally speaking, they are a mixture of different types of government bonds and other hedge fund type products that can protect if there was a significant rise in volatility. So things that are there that potentially could help if markets did deteriorate. In terms of equity exposure, so again, US still our largest exposure, which clearly has been helpful this quarter. However, we are maintaining a healthy allocation to other markets, and as I mentioned, the Chinese are in a position to ease monetary policy, which should be supportive of their own economy and of the local region. So because of this sort of difference in approach from the US Federal Reserve to the Bank of England to European Central Bank to the Chinese central bank. This is leading to sort of different outcomes in different regions, which is not something we always see. Usually there's quite a synchronized move. So that's, I think, adds emphasis to making sure that we are diversified, and we're not sort of just concentrated in any one particular market. We are still focusing on large companies over small companies. We think, again, restrictive policy, lending conditions are very, very tight at the moment. So, you know, a lot of smaller companies are going to struggle to find finance unless they go to the private markets. And so, and again, you know, large caps or larger companies have seen these environments time and again for, you know, many, many decades, or even longer. So we've gone for large over small, and again, remaining with a quality focus. So ensuring that the companies we're investing in are high quality businesses that are much more likely to survive this environment than companies that are highly indebted, for example. And we've also maintained our focus on having a minimal style bias. So what that means is we don't want to have too many companies that are very growth orientated, and we don't have companies that are highly tied into sort of the economic cycle. It's very difficult to decide which one is going to be right at any one point in time. And what we're seeing is that there's very sort of rapid and short-lived switches between each side. And so the best course of action is just to have a blend of all of them and just remain neutral. That's actually stood us a really good stead for the past 12 months or so. In terms of actions, we've actually, you know, implemented a lot of what we wanted to do. As some of you would know, we were very active last year as the new environment was unfolding, and we have been implementing our ideas around protective strategies, as I mentioned. So at the moment, we don't really have many plans for the portfolios, as in immediate changes. Two things to mention. One is for the core strategies, for those of you who are invested in our core models, which is where we have active funds and some passive funds blended. We are thinking about slightly increasing the exposure to the passive holdings where applicable. And we believe that that should result in a lowering of your overall charge. And then the other one is, look, at some stage, we are going to come out of this difficult environment of higher rates, etc. And we will start a new economic cycle. You know, your central banks will go back to cutting interest rates and promoting growth and all those sorts of things. Clearly, we have no idea when that's going to start, and we would like to have started for it to start sooner rather than later. But eventually it will come. And so the portfolios in that environment will need to look a little bit different to how they look now. They'll need to have more risk in them. And so we have already developed plans around that. We have portfolios that, or funds or strategies that we have earmarked for inclusion. And we are now just sort of, you know, in a sort of waiting game, if you like, for the opportunity to come along. So just in summary, markets are likely to be supported in short term by easing inflationary pressures, but the talk of high interest rates clearly could be a headwind, and that may well lead to more volatility later this year. Again, flexibility and nimbleness will continue to remain key as we continue to navigate an environment that is quite tricky and we haven't seen for many years. So on that, we'll move to Q&A. Please feel free to put through your questions. Happy to answer anything. Tommy, over to you.
Yeah, cheers, Owen. Thank you for that. It's certainly very interesting and very topical with everything that's going on in AI and artificial intelligence and developments going on there. It seems, you know, week on, month on it, there's always a new development going on, which I guess sort of summarizes the pace of which you know, that industry is working on. Unsurprisingly, we do have a couple of questions on artificial intelligence, and quite an interesting one is you know, you spoke about how, you know, NVIDIA is, I think, is the big name here, which has benefited from this recent resurgence in AI. Do you think there's a risk that, you know, such an important sector can become too dependent on one large company like Nvidia? Or do you see a scenario where more companies sort of grow and develop and sort of take market share as well?
Actually, whilst Nvidia is the primary producer of GPUs, as they're called, or processing units, they have lots of competition, that's for sure. And there are several other businesses that down the line could actually, absolutely take market share from Nvidia. Given that, AI is probably going to become, apart from climate change, the next sort of, the next sort of big theme over the next decade or plus. Clearly, there's going to be a huge amount of resource going into that particular sector, and so, lots of governments will be getting involved at the company level, particularly obviously in China, where they'll be trying to take some of that market share. So yes, there is a dominant player at the moment, but from the research at the moment is that that's highly unlikely to remain like that.
I guess that then reflects the performance Nvidia has seen. This last year, as you referenced, is up sort of 200% in recent months, which is, as you also referenced, probably quite sustainable. And I guess another question that came in was, can the recent rally of these companies continue? And I think you sort of answered it earlier. Well, those sorts of rallies probably aren't sustainable. But yeah, again, your thoughts would be welcome.
Yeah, that these sorts of rallies are, we see them whenever there's excitement around any particular sector. An example is after the pandemic, there was lots of hype around cloud computing and the adoption of that. Some of those stocks saw enormous gains, only to give a lot of those up through the course of 2022. Clean energy is another one. Lots of clean energy tech orientated names saw enormous gains through 2020, 2021. Again, a lot of those have been given back. So this is not unusual. We see this regularly, and I would not be surprised at that to see if a lot of those gains are given back over the next sort of couple of years.
Sure. I think another interesting point, we touched on the winners of AI, and often probably largely ignored are the losers of AI. And is there a risk of sort of certain companies being left behind, or do you think because AI is so big and will become so prevalent, do you see a sort of world where most companies do adopt AI and try and make the most of it?
Yeah, I think all companies will have to adopt AI to varying degrees, especially those that are very labor intensive, because general research suggests that very labor intensive businesses tend to deliver lower returns on equity, and so and there will definitely be a case where some businesses will have a stronger adoption than others, and they will therefore be able to potentially generate higher productivity gains, and therefore better profitability, et cetera. And so, I think there's going to be in widespread adoption, and in certain sectors, there's going to be, almost a strong level of competition in terms of AI adoption and how they integrate that into their business models.
Yeah, interesting. I think also kind of a good point to note for the listeners will be that when we meet with sort of fund managers and listen to them and they talk about the companies they hold in their portfolios, it's very interesting because they talk about the companies that have done well, but also those companies that haven't done well, that perhaps the market currently doesn't think will be able to adopt AI. A lot of our managers are seeing that those companies are being unfairly punished, and you're seeing their share price sort of go down in value. And it's just, we get interesting insight into how the managers move around their portfolios based on that. And what you've seen is for a fund that would hold Nvidia, that has done extremely well this quarter. They will sort of trim their allocation there and reallocate those proceeds into another company that hasn't done as well, but they still feel the prospects are pretty good for. So it's interesting that I think you'll see that over the coming years is there will be perceived losers that currently may actually become winners later down the line. So it's definitely exciting sort of industry and sector to keep an eye on. We did have another question sort of on the UK, and I think because, you know, unfortunately you paint a slightly bleak picture of the UK economy, and I think we're all aware of the troubles there and the struggle that sort of is going on at the moment. You touched on a little bit on the impact of higher rates in the UK equity market, but because it's such an international market, you know, we've got lots of big companies who actually don't have a lot of their revenues and profits coming from the UK. You know, are those companies somewhat shielded from the UK's economy because of their international exposure?
Yes. So a large proportion of the FTSE 100, for example, yes, most of their revenues come from overseas. So they've got really nothing to do with the UK. However, the unfortunate thing is that when you're talking to investment allocators globally, so let's just say we're talking to somebody in the US, and they're thinking about making investment decisions and investment allocations. You know, the UK is just sort of seen as a very difficult place to invest, and is not as attractive as some of the other regions, such as the US, for example. So as a result, really since Brexit, we've just seen a very steady outflow of capital from the UK equity markets. And, you know, despite the fact that a lot of those businesses, the large cap FTSE 100 businesses, don't really have anything to do with the UK and are international, you know, from an outside perspective, they're just viewed as one thing. And so as a result, you know, we just keep seeing outflows from the UK, and that's even started now for allocators in the UK, by the way, as well. So a lot of our peer group have adopted a model where they've decided to begin divesting from the UK markets. So, you know, it's very difficult in that you've just got this wall of money slowly flowing out, irrespective of whether you're an international business or not, or, you know, how tied you are to the UK economy. So yeah, it's difficult from that perspective. But yeah, you know, clearly those businesses are shielded from the UK markets or the UK economy's, you know, difficulty at the moment. But that may not necessarily change the fortunes of some of the names in the FTSE 100.
Brilliant. Well, we don't have any other questions currently, but as always, you know, if you have any other questions you'd like to ask us privately, you can always email Mo, myself, or your advisors, and we'll happily sort of answer any questions you have there. It's also a good point to note is that, you know, we have a great benefit in that we receive a lot of research and information about certain themes and topics like artificial intelligence we've spoken about today. So if you are interested and do want to sort of find out more, we can happily provide you with some research notes we've been sent that can give you a bit of a more detailed view on it, because it is you know, really fascinating. So yeah, with that, I'll say thank you everyone for joining, and thank you, Mo, for hosting.
No, thank you. Thank you all for joining.
Cheers, guys. Have a great day.
Take care. Cheers.